Hi there, in today's video we're going to be talking about AT&T. The share price is currently at a 10-year low, give or take a few pennies. We're going to be talking about, is this a continual decline that's going to continue down, or is this nearing the bottom and will we be seeing it go back up again now? That's what we're going to be covering today. I'll be looking at the fors and against. I know this is a stock that people either love or hate, or it would even appear love to hate. So I think this is one that will probably cause quite some debate down in the comments. If you do invest in AT&T, please do let me know in the comments down below. And if you don't invest in it and you've got a reason why you don't, again, let me know in the comments down below because I'd love to hear from you. Either way there on that. It's always interesting for me to see. If you're new to this channel, welcome. My name's Andy and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell and then you'll get notified every time I release a new video. And if you enjoy this video and find it useful, please do remember to give it a thumbs up. Apparently that spreads the word on YouTube and helps the channel and helps me, and of course I do appreciate that. I do just quickly need to let you know I'm not a financial advisor, so this is not financial advice. You do need to do your own research before investing in any stocks and shares. With all that said, let's dive in. So as I said earlier, AT&T is either loved or hated. Now, hopefully you all know what AT&T is. If you don't, I did make a video previously that was requested actually, which was AT&T versus Verizon, which is another big telecoms company. I'll put a link to that up there and in the description down below. So if you haven't seen that video, you can go and check that out. And in there, I do go into more depth about AT&T as well as obviously Verizon. But in short, AT&T, it makes its money in a number of ways. It's a telecoms company. It's also a media company. It owns Warner Media, which owns DC. So yes, these guys have Superman on their side. How cool is that? But they've also, and this is one of the things that the people who don't like them, if you like, don't like, is they have made a whole number of purchases. And as a result of that, the debt level of AT&T has grown quite large. Now, they are looking to get that under control. And that is one of the things I'm going to be reporting on for you in this video today. We're going to look at what they're doing about that. I'm going to be looking at the pros and the cons. I'm going to be looking at what people do like and don't like about AT&T. And at the end, of course, as always, I'll give you my own opinion, my own thoughts and my own forecast as to whether this is a buy or not a buy. And I'll let you know if I've been buying it or not. So with that said, let's move on. AT&T stock. So we're going to start with a site this is from investors.com, which is the Investors Business Daily. They seem a bit negative on AT&T. They're definitely down on it. So let me read to you from a recent article that they have written. Despite being one of the most recognizable wireless phone carriers in the US, telecom and media conglomerate AT&T has had a rough 2020. AT&T stock is down 30% year to date, even after recovering nearly 30% from its lows of the coronavirus bear market. But the stock does have a high 7.6% annualized dividend yield in a 1% interest rate environment. Should investors consider buying AT&T stock? Now we're going to take a look at the charts a little bit later, so we'll see just how true that statement actually is as to where it does sit to its lows. Now, we'll be looking at that later. Their article then goes on to say AT&T reported third quarter earnings on October 22nd. Earnings for the September quarter met analyst estimates, whilst revenue came in above Wall Street projections. Unexpected growth in wireless subscriber additions remained a bright spot in the Q3. Shares jumped nearly 6% on the news. The firm's third quarter profit declined to 76 cents a share, down 19% from a year earlier. Revenue dropped 5% to 42.34 billion. A year earlier, AT&T earned 94 cents a share on a revenue of 44.58 billion. The telecom giant acquired satellite TV broadcaster DirecTV for 49 billion in 2015. Many people say that was a mistake. And TV Warner for 85 billion in 2018, which so far has yet to really gain traction. Warner Media revenue fell 10% to 7.5 billion amid an advertising drop at Turner Broadcasting and delayed movie releases, because just like Disney and all the other competitors, making movies in 2020 has been exceedingly difficult because you can't do that when you're in lockdown and the stay-at-home orders in place and the like. So that has messed up production of new programs, which is essentially what Warner Media does. If you think about it, it makes movies, it makes films, it makes series, You've got to remember AT&T own things like Game of Thrones, so producing those kind of things, they would look a bit silly with face masks on, wouldn't they? As for its postpaid wireless phone customers, AT&T gained a total of 645,000 customers, including 151 subscribers that stopped paying but were kept on the network to comply with government programs. The firm's entertainment segment continued to struggle, losing 590,000 pay TV subscribers for the quarter. I should just add there, that's their cable service, that's not their HBO Max service. AT&T lost 370 internet video subscribers. The heavy loss was due to the cancellation of most live sports. Analysts see 2020 EPS fall 11% for AT&T. They estimate a 1% gain in 2020. They then go on and summarize by saying, is AT&T stock a buy? And they literally say AT&T stock should not be bought right now based on its fundamentals and technical analysis. Investors want to prioritize stocks that have seen growth of at least 25% in earnings and sales in recent quarters. T stock currently falls far below that. Despite its over 7% dividend yield, AT&T stock has dropped 30% in 2020 as the company's increasing debt has deterred many investors. Shares initially climbed following the latest earnings release, but have a long way to go before reaching the nearest buy point. AT&T stock is not one to be added to your portfolio right now, so investors will need to wait for the stock to form a better chart pattern and regain strength fundamentally. Now, I should say I've missed a whole chunk of that article out because it was all basically analysis of the actual share price. But the basic gist of it was they want to see the share stop going down and start going up for a prolonged period of time and pass one of the moving averages, which is what analysts like to look at, before they say it's a buy. So the long and short of it was, I think they said it was about $35, $34, at that kind of price range it should start to become a buy. That's their logic anyway. Whereas Investor Business Daily are obviously on the bearish side. They're very negative on AT&T. Forbes are very bullish on AT&T. So now let's take a look at Forbes, what they have to say in a recent article. They put AT&T stock with a 20% growth potential. We believe AT&T stock, New York ticker symbol T, may be a good opportunity at the present time. AT&T trades at $28 currently. It's actually currently lower than that. This article was before it's dropped, and is in fact down 29% so far this year from $39 at the beginning of 2020. It traded at $38 in February 2020, just before the coronavirus pandemic hit the world, and is currently 28% below that level. This is after AT&T stock gained 4% from its March lows of less than $27. The stock has underperformed the market over recent months because of the lackluster debut of HBO Max and also the intense competition the company faces from Verizon and T-Mobile in the 5G technology expansion. But the gradual opening up of the economy is expected to lead to recovery in consumer spending in the coming quarters, while HBO Max is also expected to gradually increase its subscriber base, albeit at a slower pace. This could drive the stock 20% higher from its current level. Our conclusion is based on the comparative analysis of AT&T stock performance during the current financial crisis with that during 2008 recession in an interactive dashboard. And the interactive dashboard they use is tariffs. I'll put a link down below, and this is what that looks like. And as you can see there, they've got an analyst's estimate price of $34 per share. Well, it's currently trading well below that. And one of the parts I particularly liked on here was comparing, if you look there, can you see it says comparing AT&T's revenue growth with that of its major peers. And look who they've chosen for its major peers. They've chosen Disney, that's because it owns Warner Media, and they've chosen Verizon. And you can see AT&T was down in 2017, up in 2018, stayed the same kind of level in 2019, has dipped in 2020, but is expected to go back up again in 2021. This is compared to Disney, that basically went straight up from 2017 to 2019, fell a little in 2020 and is expected to fall a bit more in 2021, or Verizon, which is basically a flat line all the way across there. So now, rather than looking at what the media are saying, one side or the other, and I tell you now, if you go onto any investor forums or any Facebook groups, that's what it is like. There are people who absolutely love AT&T and there are people who absolutely hate AT&T, and they argue constantly with each other about it. what we're going to do now, we're going to look at their investor presentation, then we'll go on and we'll look at their actual share price. So we'll be able to see how the shares have moved, like I said, and then at the end, I will be giving you my thoughts and my opinion of where I think it's all heading. But now I just want to gather the facts. So let's have a look at their investor presentation. So here we can see their third quarter investor presentation they've released quite recently. What are they focused on? So they're focused on market-based priorities, 5G wireless and fiber-based connectivity. I'd say that's a good thing because that's something of the future. And it's worth noting here that AT&T actually have the largest 5G network in all of the USA. So they have the best coverage, if you like, the largest network of 5G in North America, in the USA. So if you are someone wanting to get a phone and you want good coverage, actually they are a very good provider for that. Now again, there'll be people who argue the toss on that front, but it is a fact that they have bigger 5G network than anybody else in the nation at this point in time. They're expanding reach of software-based entertainment platforms. That means things like HBO Max and the like, and relentless commitment to customer experience. Look at the bottom section here, improved balance sheet and deliberate capital allocation. So they're investing in strategic growth areas, 5G wireless, fiber and HBO Max, which I see as very good personally, because 5G is definitely the future. When we're talking about cars becoming automated, they're going to need 5G. 5G is going to become used in so many things that if you are a big network carrier, and currently they are the biggest, then you stand to gain from that because people will be needing to use that network. Then they're also looking at fiber, obviously super fast broadband. People need super fast broadband. Me as someone making and uploading YouTube videos, I need super fast broadband. And HBO Max, I see HBO Max as like a little version of Netflix, and I actually think it's got a lot of room to grow. If you think Netflix is a big company in its own right, Disney also has brought its own Disney media out now, pushing Mandalorian, which has really fueled its growth. HBO Max hasn't really had its new content. Apparently it's been doing really well at retaining customers because it's got a big back catalogue library, but I'm told to get new customers in, what you need is new content. Well, they have new content coming out next year, so maybe that will see an upsurge in new subscribers to the HBO Max channel then. Remember, these are the guys that brought you Game of Thrones. They're bringing out Land of Dragons, I think it's called, which is apparently set 100 or 200 years before Game of Thrones. That was popular everywhere in the world. They won't just be releasing that on HBO Max. They'll be leasing that to other media companies, such as, for example, in the UK over here, we don't have HBO Max. So if I want to watch things like that, I have to watch it on Sky Atlantic, which of course they lease that from HBO, so which is in turn owned by AT&T. So that is an income stream that is obviously likely to grow for them in the future as far as I'm concerned. They're committed to supporting dividend. They've got a solid 36-year record, and that's true. They've been increasing the dividends year on year for 36 years, and it's nice to see they've got that written in there that they are committed to that. So that's a little nod to investors to say, look, don't worry folks, we're committed to that dividend, which is a very high dividend yield, and that's obviously one of the big reasons why so many people love this stock, because it is such a high dividend yield. Of course, on the flip side, other people the haters, if you like, will say it's a value trap because it's such a high dividend. So, we'll come to looking at the numbers in a minute. Further debt reduction, focus on metric improvement. Again, I think that's very important because they have got a lot of debt. And continued portfolio review, monetizing non-core assets. So some key takeaways on here. This is in Q3 of 2020. 1.1 million postpaid net adds on wireless and fiber broadband, 645,000 postpaid voice, 357,000 fiber net adds, and 158,000 total broadband net adds. And on HBO and HBO Max domestics, subscribers are up to 38 million, which is now 57 million worldwide. And HBO Max activations have more than doubled. So it is growing, and it is growing at a reasonable pace in that respect. Then I want you to look at the bottom section of this where it says deliberate capital allocation, improved cash flow, significant debt management. So they're very much aware of this debt issue and they are working on that. Since Q1 of 2020, they've reduced or extended 30 billion of near-term maturities, and we'll look at that in a moment. They expect 2020 free cash flow of 26 billion or higher, with a dividend payout ratio in the high 50%. And they're committed to investing in strategic growth areas. Now on here, I want to point out They've got almost 1 million more postpaid phone subscribers and a falling churn, which is good because the churn, if you don't know, that's the amount of people leaving, if you like. So it's the turnover. So they're more likely to stay. The lower that churn number, the better, basically. So you can see the number of subscribers has got higher and the churn rate has got lower. And this is actually one of the things I like about AT&T is that it is a subscription-based model. If you look at any area or most of its areas of business, you pay a subscription, you pay it a monthly fee, you pay it to get your fibre, you pay it, you know, if you were getting the old cable subscription TV, it would have been a monthly payment. That admittedly is in decline now, but HBO Max, it's a subscription model. So it's a nice stable income, which actually lends itself well, I think, to a dividend company. If you think about REITs, they collect rents, usually on a monthly basis or a quarterly basis if they're commercial REITs, and then pay them out in dividends. This also has regular income coming in on a subscription model. I like that in a business, and a lot of companies have gone that way. Even bigger companies like Microsoft have now started making it so that their service is subscription. Adobe, if you want to use a lot of the Adobe software, you have to get a subscription to be able to use it, because they've worked out they make more money on a subscription than they do just selling you the solid product. So I do like companies with subscription-based models. That's one of the things I like about this. So it's really nice to see that their phone subscribers are increasing and they're losing them slower, if you like. Their churn rate is getting better. So their fibre subscribers have increased again by 1 million subscribers, and this time, note, the yellow line is penetration, not churn. Otherwise that would have been a bad thing. But I think what they're getting at there is they're penetrating a larger segment of the market. And then if we look on the right hand side there, 3.4 million more HBO and HBO Max subscribers, which is obviously fabulous. And all of this, of course, increases their future recurring incomes, which is important. Now let's look at a financial summary here. This is where it's not quite so pretty. So if you look Q3 2019, the earnings per share was 94 cents. Q3 2020, so like for like year on year, it's 76 cents. So that's fallen. So that's not good. Revenues have also fallen. So in Q3 2019, they were 44.6 billion. And in Q3 2020, the 42.3 billion. So that's down. What is a better picture is the cash from operations, which is actually up by almost $1 billion. It's also worth noting here, which I mentioned earlier, the expected free cash flow of 26 billion or higher, with a dividend expected payout in the high 50s. That's good because that's a relatively safe amount percentage wise. Here is the key slide that's very important for you all to look at for the debt. Everybody is saying how bad the debt is. Look at the debt. So you can see 2018, which is when they bought Warner Media, which was obviously a big purchase and they had to borrow to do that. Their debt was 180 billion. That has then fallen and currently stands at 149 billion. So it's still a big debt. There's no two ways about that. 149 billion is big, but it's a lot smaller than it was. And now look at the debt towers. So that's when things are due for repayment, and you can see the dotted line shows when they were due for repayment and the blue shows when it now matures. Okay, so you can see how they've adjusted their debt, and they've done that to take advantage of the current low interest rates. So they've basically refinanced things, pushed the final payments back so they've got a longer period to pay for it, and done it at a lower interest rate, which is obviously very prudent indeed, because that improves the cash flow of the company and it allows them to pay it off faster if they want to, but they can pay it off that little bit slower but at a lower interest rate, which means it costs them less to do it. And you can see that they've got in 2020 2.3 billion maturing, in 2021 2.8 billion maturing, in 2022 6.5 billion maturing, in 2023 7.7 billion maturing, and so on. And remember, they said they had, I think it was 26 billion of free cash flow expected. Here they've put year-to-date free cash flow so far of 19.8 billion, which obviously more than covers that 2.3 billion there that needs to be paid out. A dividend payout ratio of about 45% in Q3 of 2020, 57% on year-to-date, and a 50% reduction in maturities over the next 5 years, which, as they put it, provides flexibility and manageable near-term debt towers. Overall weighted average maturity of 17 years at 4.1%, improved from 13 years and 4.3%, which is what it was at the start of the year. So you see what I mean? They've extended it and got it on a lower interest rate, and on top of that, they're currently sitting on a cash balance of $10 billion. They're also looking to sell some assets, so they've got $3 billion in asset sales announced and expected to close by the end of 2020, including CME, which is closed now, Puerto Rico expected to close in October, and exploring sale of non-core assets, services and other businesses. Now that's one of the things some of the people who don't like it say is they're selling off too many assets. Others actually are quite positive on that and say they should be getting rid of other assets. My view is any business, if you've got something that's not making money, get rid of it. And if you've got something that is making money, do more of it, focus on it and make more money. So I think they've got the right idea. They have, without a shadow of a doubt, made a lot of mistakes in the past. They've bought things they shouldn't have bought. They've bought things at the wrong time. They bought a cable company just when cable was declining and internet services were increasing, internet streaming type TV services were increasing. That was obviously a massive foot in the mouth moment for the management, and I'm sure they're highly embarrassed about that, and that has cost the company dearly, and that is one of the reasons it's fallen out of favour. But they are now getting rid of the dead weight, if you like, and focusing on the core future growth assets as identified in the previous slide. So now I just want to quickly look at the income statement, and what I want to look at here is the year on year. So I'm particularly looking at the columns for the end in September, basically, so you can see a comparative. So you can see in 2018 that was 45,739, whereas in 2019 that was 44,588, so it had fallen, and it's fallen again, this is the operating revenues, to 42,340, and these are obviously millions, in 2020. So that isn't good because you're seeing a declining picture there, which is not something you ever want to see in any company if you can possibly avoid it. And the earnings per share on the quarter for the third quarter of 2018 was 90 cents per share. That increased to 94 cents per share in 2019, and in 2020 was 76 cents per share. So you have to decide, do you think that's going to increase or decrease? Because if that's going to continue that slide, then this is definitely not something you should be investing in. If, however, you think it's due to the pandemic, it's due to everything that's happening this year, actually I think things are going to turn around, then fine, invest in it. But that's something to bear in mind. The trend over them 3 years on this particular quarter has been down. So it will be very interesting to see what the next quarter brings. I'm not going to go through these slides in great detail because it will make the video too long, but I've put them on here so you can pause it and come back and you can literally see which segments are growing, which segments have fallen. So if you look, mobility, which is the mobile phone side of things, was 17.7 billion back in the third quarter of 2018. It was pretty much the same. It had fallen slightly in the third quarter of 2019, and it's actually increased now to 17.8 billion in the third quarter of 2020. So that's good. Whereas if you look at the entertainment group, that has actually fallen by about $1.5 billion, and the business wireline has also fallen by about 300 million. If you look at the Warner Brothers side of things, Warner Media was 8.6 billion in 2018, fell to 8.3 billion in 2019, and then is down to 7.5 billion in 2020. So if you think that decline is going to continue, personally, I think it's down to the pandemic. I do think that is going to turn around, but that's my personal view. You need to take your own view on that. But I think it's been very hard for any of these companies. If you look at any of the companies in the same sphere, they're all struggling because they can't produce new content right now, or haven't been able to, certainly not at the same pace, at the same cost as they would previously. Everything is costing more to do, taking longer to do, and being delayed. Box offices, cinemas are closed. If you're aware of the whole cinema fiasco, cinemas are closed, which has caused one of the other stocks I've reviewed quite a lot, EPR Properties. I'll put a link that below and up there as well. EPR Properties as well is being hammered by that. It is hurting the producers of the movies, as well as the landlords of the theatres, as well as the theatres themselves. Of course it is, because that's one of the big revenue streams for any company that produces movies, and these produce a lot of movies. This slide shows you how they're doing on mobility, which, as I said, is growing nicely. But the reason I'm showing you this slide here really is just to let you know it's their biggest segment, and look how their subscriber base has grown quarter over quarter. if you just look at that total subscribers and connections at the top line there, 149, 151, 154, 158, and so on, it just keeps climbing and climbing and climbing, and those are in thousands. So that is a lot of subscribers, which gives a nice big growing recurring income from that segment of the business. Cable TV, which is a video entertainment, as you can see there, that is declining. The high speed internet has had very slight growth, whilst the legacy voice and data services are also in decline, quite frankly. The business wireline service seems fairly static, but has declined in 2020, mainly due to its legacy voice and data services. And then here is Warner Media, which, as you can see, its total operating revenue has been down in 2020. Basically, it's fallen off. But as I said, we kind of expected that. This is to show HBO Max and HBO, so you can see their subscribers here. The volume is obviously in thousands, so where it says 34,500, it's actually 34 million. So you can see it's basically gone from 34.5 million up to 38 million subscribers in the space of 2020, which I'd say is pretty good growth, quite honestly. I'm quite happy with that, and I think that growth is going to grow, and I think it's actually going to speed up when they start releasing new content, because they're really living off their old content at the moment, and new content is going to make that. They're living off their old content. They've got Game of Thrones, they've got so many other big brand things that they own. They own all the DC, for example, Wonder Woman, Superman, Batman, and the like, all of that. So they've got plenty of existing content, but they need to bring the new content out. As new content comes out, that will attract people to HBO Max, and that will get more subscribers, and then their back library, which is phenomenal, will retain the subscribers, and they've already demonstrated they're good at retaining them. They just need to be a bit better at gaining new subscribers. And remember, Netflix are doing really well. Netflix have just increased their price, which then makes HBO Max seem better value. And you never know, HBO Max might increase their price as well, as might Disney Plus for all I know. But you see the point I'm getting at here. It is a growing market, and I do think they've got a place in that market. So now let's look at the balance sheet here just quickly. This is just a part of the balance sheet. I just want to point out the book value per share has actually fallen. So in 2019, September 2019, you see it was $25.06, whereas in September 2020, that had fallen to $24.64. So that's not exactly great. So the total debt is falling each quarter, with the exception of March 2020. So you can see it's basically fallen from 197,000 down to 180,000, which is a good thing. So they've reduced it there. And the net debt has also fallen from 190 down to 171. So you can see they have actively been knocking the debt down. So now we're going to look at the share charts as well as the analyst forecasts. So this chart here shows you the 3-month share price of AT&T, and you can see why people who don't like it, because that has been pretty much straight down. So you're thinking, well, maybe it's just because you're looking at 3-month chart, because, you know, imagine if you bought it 3 months ago at $30 and you're holding it today at $27.43, you're not a happy bunny. What about 3 months, 6 months chart? Well, there's a 6 months chart. If you bought it at the peak up there, which was around $33 per share, and you're holding it at $27 per share, again, you're not particularly happy. So what about the year to date? How's it done? Well, year to date it's well down. It's gone from up there $38 per share and a peak there of about nearly $40 per share, and it's now down at 27. So again, you're not going to be particularly happy. You can see the lowest it was about there, about $26 per share. It must have dipped a little lower than that. It was here, it dipped lower. So yeah, so it did actually dip lower than its March lows. So its March lows was about $26.80 per share, it looks like, and it did dip here to approximately $26.45-ish cents per share. So what if we go for 1 year? Here's the 1 year chart. That's what that looks like. You can see it was trading up here, $39. Again, you would be upset with that. So let's look at a 5-year chart now. 5-year chart is a bit more up and down. It peaked at around $43 there, it looks like, just over $43, $43.50-ish. So, you know, if you'd have bought it then and it's fallen, you're going to be very upset. And if I look at an all-time chart, so this is the longest term, you can see it hasn't been the prices that it is now since August 2010. So we're sitting at a 10-year low right now. And it has in the past peaked much higher. If we go all the way back here, you can see it was $58 per share back in July 1999. So, you know, you're going back 20 years and that's where it was. So if you'd have bought it back there and you're still holding it now, you're going to be quite upset, because generally speaking, they always say if you hold a stock for 20 years, you're going to win. Well, not in this instance. If you'd have bought it then, that would have hurt. Now, you would have had a lot of dividends in that time. We'll come to dividends in a minute, but your capital price, if you like, you would definitely be down. Now, prior to that, it was a very healthy growth. Look at that growth. Boom, 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 straight up. So, you know, had you bought it way back when, in 1984, so had you bought it in 1984, you would have paid $4.79. You wouldn't actually be that bothered that is currently trading at a $27 mark. You would be quids in, so to speak. But bear in mind, versus the S&P, you would without a shadow of a doubt be behind. So that's the stock price. That's what the charts have been doing. I mean, I would describe that as roller coaster, to be honest with you. You've got this steep climb, you've got a steep drop, you've got a climb, you've got a drop. And then here, this area around 2011-ish, it seems to stabilize. It's still up and down, but it's very much trading within a kind of range, give or take. It doesn't seem to often go below $30. If you look, if I put my line where $30 is, it's not gone below $30 very often. And it doesn't very often go much above $36. It seems to be between that $30 and $36 range. If you want to be a bit tighter, $31 to $35 range. So there is a trading range, and I know some people do sells and puts on AT&T for that reason, because it does trade within a range. Let's look at the analyst forecast for AT&T. So this is a 12-month analyst forecast target for AT&T. They've got an upside of 14.98%. So they're saying you'll make nearly 15% in the next 12 months if you buy AT&T at its current price of $27.44. 6 analysts have it as a buy, 5 analysts have it as a hold, and 3 analysts have it as a sell. You'll see they've got a high price of $38, an average of $31.55, and a low of $24. So there are analysts that think the share price has further to fall than it has already fallen. So AT&T's dividends, as you can see there, it's a thing of beauty. It has been growing for 36 years. This website I'm using here, Seeking Alpha, doesn't go back that far. But one of the things I want you to notice is it increases it by a penny every year since 2008. You look, it was 40 cents, and then next quarter 41 cents. We go 4 quarters and it goes up 42 cents. We go 4 quarters, it goes up 43 cents. 4 quarters, it goes up 44 cents. 4 quarters, it goes up 45 cents, and so on. This pattern continues. 1 cent every 4 quarters it goes up. And we've currently just had our 4th quarter at 52 cents per share. So here's my prediction. You heard it here first, folks. The next dividend for AT&T, I predict, will be 53 cents. Not exactly mind-blowing, but based on their previous performance and the fact that their payout rate is in the 50s, so they've got room to improve it. And they said in their presentation that it's important to them to maintain their strong dividend record, which is a 36-year record. I think the guy who actually breaks that record is going to probably get hung. So I think the odds are they're going to go up, and they're going to go up by another penny. I think it's unlikely they'll go up by more. They could, but I don't expect them to keep it the same, and I definitely don't expect them to cut it. I expect the next dividend to be announced, which they should announce in about 6 weeks' time, I think mid-December. When they announce that, I'm expecting them to announce it at 53 cents per share. You heard it here first. There you go. There's my prediction. And of course, if they do, that will increase the dividend yield. So if you have bought them now, that will increase the yield on the price that you've paid. And I'm going to make a whole other video about that. So what do I think of AT&T? Well, I think you've got a strong dividend yield. It's over 7% dividend yield, and I do believe they're going to continue to increase that. I think it's at the bottom of its trading range. I think it's pretty much near its 10-year low. As I said when we're looking at the charts, I think really it's happy in a range of between $30 and $35, $36 per share. So that's the range it trades in. So theoretically, if it's under $30 per share, it should be safe to buy it if you're going to hold it long term. I do think that it's going to go back to that range. That's my personal view. I particularly like that it's pushing 5G. I really like HBO Max. I like that it's getting rid of a lot of its old less profitable areas of the business, should we say. So I personally think there's a lot to like. I think it's important that it continues to pay down debt. That's something I would particularly be paying close interest to, and I will be paying close interest to, and I think you should if you do invest in this company. And would I buy it? Actually, I did buy it, yes. I bought AT&T at $26.48 per share last week. So that was pretty much near the bottom, which was jammy, I admit. I had a bit of luck on my side there. I was basically aiming to get it for under $26.50. I was watching it and it was falling, and I said to myself, if it goes below $26.50, I will buy it, and it did, so I did. And that's how I do it. I have my set levels that I'd like to buy at. In this instance, I bought 100 shares. It's since gone back up again. If it goes down again, having done more research on the company, I'm even more confident and bullish about it now in that respect. So actually, I would now be looking to buy more. Certainly if it went to them levels, if it went up to under $25 per share, I would consider it a bargain and would be super keen on buying it. I know one of the forecasts, the analyst forecast, said it could go down to $24 per share. If they are correct, I will be buying it, quite honestly. But I think it's unlikely. I don't think it's likely to happen, but you never know. It is a volatile stock. It does go up and down. It's not one that you should buy if you're not comfortable leaving money for a long period of time, because it is going to continue to go up and down. However, remember, you do have that nice dividend which will increase over time, and I'm actually planning on making a video showing how a company with increasing dividends such as AT&T, how your investment on your initial capital, how that yield increases over time, so that you can see it. And I'm actually planning on making that video quite soon, so if I do, I'll try to make it the next one you see on the screen or down below. Other than that, thanks for watching. I really hope you found that useful. Have a nice day, and bye bye.